to admit that I'm a shareholder in Warner Brothers, but I received those shares as a spinoff when AT&T spun off WBD. And part of my strategy there, I thought they would do better, and they actually did. There was a point in 2021 where they went up 263% in less than probably about 5 months.
How
So
much was that?
it was 270,
Jeez.
263% approximately in about, in just from November of 2020 to March of 2021. That was a three bagger over that time. So then you can see what they've done since then. But anyway, I got these shares, and then they lost big. I sold some and decided just to hold on to the rest. And then in 2022, I did a Roth conversion. So I converted that over to a Roth, paid taxes on the lower amount. So from a tax perspective, that was somewhat of a good move. And then I just held them there because I created the Roth that year. So I can't touch that money for 5 years other than the capital that I put into it. I can't pull out gains tax free for 5 years. And then in 2023, I did a subsequent Roth conversion with a few other stocks. So that money in 2023, I can't touch for 5 years. So anyway, I just thought I would let it ride in there. So anyway, let's look and see what happened just yesterday. Is they were up 28% and as high as about 33% during the day. And this was on a rumor, somewhat of a confirmed rumor, that Paramount Skyworks was going to make an offer on Warner Brothers. And let me point out that Warner Brothers, about a month or two ago, announced that they were going to split into two separate companies. So anyway, Paramount Skyworks is going to put an offer on the entire company. And with that happening, there were other companies that might have been interested in only half of the Warner Brothers business. So when they split off, there could have been a buyout. So next year sometime.
Let me guess. Everybody wants the half that has Bugs Bunny.
Yes.
Perfect.
Yep. So, and there is a lot of content that Warner Brother has control over. The streaming, I don't think is probably ever going to be a good business again. I just don't know. But anyway, there's talk that there are going to be other companies that may jump into the fray here because they don't want to lose that opportunity to have that studio business. So anyway, I'll just leave that right there. But yesterday was one of the best days in probably 5 years for Warner Brothers Discovery.
Nice. So that's what I think you said you had a really good day yesterday, and this is probably one of the reasons, right?
Yeah, in fact, when I did those Roth conversions, they were the stock was worth about $26,000 more than what it was worth at the time of the conversion. So I only paid tax on the lower amount, which from a tax planning was a good move, I think. And because I was going to let it sit there for 5 years, I didn't have any need for that particular chunk of funds. And I would just let it sit there for the most part. I have traded some in there, but not nearly as much as some of my other accounts. So anyway, yesterday was the first day that account from those transactions have completely recovered. So I don't ever have to pay taxes on that again. So that's it's kind of wonderful news and pretty exciting.
So Warner Brothers, they've been kind of caught a little bit in no man's land. They legendary company, so many good movies, Bugs Bunny, a lot of cartoons, and their content, like you were saying, you know, is worth a lot because if you flip on, Netflix or, any kind of streaming service, their libraries to some extent are limited. And Warner Brothers has been making movies for literally 100 years. So you got movies from 30s, 40s, 50s, 60s, all the way up to modern time. And that's a pretty strong library. So the library itself has a lot of value, but they just couldn't get into like the streaming biz. The previous ways that we consumed media were quite favorable for them in the movie theater, and then DVD and video were pretty good days for them. But the streaming days just kind of changed the game. And I think that things like YouTube will also continue to make it harder on Warner Brothers and the traditional studios. I think as a consumer is kind of changing, right? I notice it in my own behavior and just about everybody's behavior. Uh, 25 years ago, we were kind of programmed to be, if you're watching TV, you're going to watch for 30 minutes or an hour. If you're going to watch a movie, you're going to watch for like, I don't know, 2 hours. The Godfather, I think, was 3 hours and it was very successful. Well, nowadays it's like, geez, you got TikTok, less than 1 minute videos. Everybody's like, you compress your expectation for media is so different now. You can watch so many things. You could go watch 3 minutes here, 5 minutes there, a couple minutes here, and get what you're looking for very quickly. And I don't know that that's going to change. I think it's just going to get better and better and better. But we'll see how Warner Brother adapts, and it's good to see that they are held with some regard and are driving up their stock price. And one more comment on the environment for acquisitions is much better. I think it's Skydance, Spot, Paramount, and they're kind of going through the whole integration of that business. And now they're setting their sights for Warner Brothers, and maybe some other bidders will come out of the woodwork. So acquisitions are going to be more active. Uh, Acquisitions, mergers, that kind of thing, IPOs. I think there's going to be an IPO today. So that environment is changing, which is very good. The previous 4 years, the Department of Justice was like, oh man, all corporations are terrible and they're trying to acquire businesses so they can really punish consumers. I'm not in that boat, but I'm not going to start a debate around that. I'm just going to point to the fact that mergers and acquisitions are going to be more active. I think they're going to be good because companies like Warner Brothers, they're getting run over by the new paradigm, which is streaming, which is YouTube, TikTok. I mean, the consumer's changing and they have to adapt. They have to have a way of getting their media in front of people that want to watch it. Aside from that, this is a relatively small cap, market cap 40 billion, even after the run up yesterday. So it was quite low. It was quite low for a while. And it is a pretty amazing chart, right? And what caused this big spike back in 2021? Was it a short squeeze or what caused that big rise?
Yeah, I think it was a little bit of meme media and a short squeeze.
Incredible.
I wish I would have sold it all about right there, but I did not.
Incredible. I had a couple of stocks do this and I sold them both.
Yeah, I wish I would have done that.
Because if I can't explain it and I'm sitting there with a big gain, I get out. So 40%, $40 billion market cap, revenue of 38 billion, PE this year is 52, and price target. Analysts think it's a little expensive now with the big run up on the stock. The revenues for the company have been declining. So the overall business is not booming. It doesn't have momentum. They do drive free cash flow of 4 billion. Looks good. Gross margins look okay. In the past, they used to be better. They used to be in the mid 60s. Now they're in the mid 40s. This I could probably say is because you are not selling DVDs anymore.
Yeah.
You're not renting videos anymore. Those days are long gone. You're now having to compete with some creator on TikTok on an island that is getting a lot of eyeballs. So I think that's a measure of how much tougher it is in their business. They are slightly profitable, although they've been very unprofitable, and they're expected to be unprofitable next year and the year after. So that's where they land there. They have 15 analysts covering them, and They all expect the company is going to grow a little bit, so that's good. Or consensus is that they're going to grow a bit, but they are going to be unprofitable for a couple years. And this acquisition is very timely. If they can merge with another company, that'd be great. One thing about them is they do carry some debt,
Yeah.
$34.6 billion of debt. So
They
they
were
do have to,
saddled with some debt with the spinoff from AT&T.
yeah. So when I look at them from a valuation perspective, I'm only going to look at um, their cash because I can't look at earnings per share because they're not going to have any positive earnings per share over the next 2 years. And they're not growing. So I'm not going to grow the first 4 years of cash. And the reason I don't grow them at all is because if you look at the last 3 years, it was actually a declining free cash flow rate. So I'm like, okay, I'm not going to decline it, but I'm just going to say they're going to hold steady.
Mm-hmm.
And when I do that, I get to a net present value of $68 billion for the cash, discounted by 9%, which is higher than a very good balance sheet company that's in an industry that's, is having better days, would probably be at 7.5 or an 8. But this one's at a 9 because of the debt. And cash is 4.9 billion, debt is 34.6. So equity value is 38.4. So right now the company is, I would say, fairly priced, maybe priced at a 4% premium. Now the acquirer is going to have to pay to buy the company. So they're going to probably have to pay a little more than intrinsic value. And because Warner Brothers can negotiate, especially if there's other bidders. So this stock is it's priced fairly, and I'm glad that they're going to be acquired. Hopefully, it's a good thing for Warner Brothers. They still have a lot of assets in California and Hollywood. Like they have one of the biggest lots in Los Angeles, and they I don't know if they lease it out, rent it out to a lot of other companies to use to make movies. So they are somewhat of they are a media company, but they're also kind of a real estate company that they rent out their studios. So that's interesting about them as well.